Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to the Investing Podcast. I'm Andrew Hall. Joining me this morning and almost every morning, Ben Nye. It's Friday, Ben.
Yeah, made it through the week.
October 7th, 2016. Special shout out to the new people who might be here. We've got a new distribution partnership, is probably the best way to put it. I don't want to say names because I don't want to jinx it, and this isn't actually up yet as we're saying this. We're not broadcasting live, but welcome. This is what we do. We do videos in the morning. You can also download them in podcast form if you want to go to iTunes, search Tusk Media. You can also find all our stuff on Twitter at Tusk Media LLC. We've actually got a live broadcast coming up for real today at 8:30, but by the time this video's up, you'll have missed that. In fact, we're going to import that video later on into this segment. So you'll get to see our live reaction on a tape delay to the jobs report and all that good stuff. So we're here. Let's get rolling. Let's talk about the market a little bit to start off, and then we'll hit a couple other topics later on. Real quick rundown on futures. Dow Futures down 20 basis points, so a fifth of 1%. S&P Futures down 27 basis points. NASDAQ Futures down 23 basis points. Oil down 16 basis points. We got gold keeping us from a redgasms when everything's down, so we're avoiding that. Gold up almost half of 1%. So everything down a little bit. I think everybody's really waiting for that 8:30 data.
Well, so, a quick shout out to the pound too, and we're going to touch on this too, but that's a little bit of a redgasm today too.
Yes, big time.
Big time.
Continued redgasm there. So we want to jump right in and hit some of these stories. Let's talk about Verizon and YHOO, a story we've talked about before. If you've missed our commentary, you can go to YouTube. Again, search Tusk Media. All our videos will come up there. You can see everything, all the descriptions, all the titles, all that kind of stuff. But Verizon and YHOO, we had this massive hack, 500 million accounts? Is that what the number is?
At least. It seems like it kills up.
It's up every time. But Verizon now wants $1 billion discount, which might sound like a lot, but then you're like, well, it's really like $2 an account for a compromised account. It's not that staggering. What's the takeaway from this?
Yeah, we had actually talked a little bit about this before, is what actually constitutes a material adverse change. Because when you do a big deal like this, you say you do the deal and then it doesn't close for another period of time. Sometimes it's just a few months, sometimes it can be a year later. And in this case, does this constitute a material adverse change if all of a sudden YHOO's liable for big penalties because of this hacking that wasn't disclosed or anything? Especially not disclosed to Verizon.
Right.
So, maybe Verizon's just in the ultimate power play right now because they could maybe even just walk away from the deal.
Right.
So maybe they just see this as an opportunity. We're actually helping you guys out. Like, you go into the boardroom and you see the Verizon execs there come in and say, we can walk away from the deal, but we're going to throw you a bone and still buy the company, but we want $1 billion discount.
What's interesting too is, supposedly Verizon set aside $1 billion of their own money to deal with the fallout of this, the prolonged impact of it. And now they're asking for $1 billion discount. So it's almost like setting up your own contingency fund for if you got laid off, but then having your boss give you a bonus in the amount of your contingency fund. So they've kind of trying to have their cake and eat it too a little bit, but at the same time, as you just said, I think they've got YHOO kind of under their thumb.
Yeah.
They rightfully so should be trying to knock that thing down as much as possible. And again, the $1 billion mark may not sound like a huge deal relative to the market cap of Verizon. You say, well, how much of an impact is that really? But when you actually look at the acquisition price, it's a big discount.
Well, and YHOO's put all of its eggs in one basket now. They've been working on figuring out how to get out of the company, how to actually exit. For almost a year, it seems to me, and they finally did it. And if they had to start from square one again, that would just not be not be good for YHOO. I mean, we kind of wonder, well, what would happen to her? Maya, would she just leave? It would be a bit of a mess.
And it almost seems like too, with that black eye and how that went undiscovered, you almost wonder if the acquirer says, hey, this is $1 billion discount, what would the open market say? Because they might actually say more, because they said, well, we know about this one thing that the purchaser said discounted $1 billion. What else do we not know about? Because this happened back in 2014. So we'll keep an eye on that. We'll continue to see what's happening there. Talk to me about Qualcomm and NXPI.
Yeah, so NXPI, a chip company, they sell a lot into the auto space and the mobile phone space. Big in vehicle-to-vehicle communication as well, so people looking at that as a potential growth opportunity. So Qualcomm, whose growth has really stagnated a bit with as mobile phones have matured, they're looking to, for a way to kind of reinvigorate that growth. So they're looking at acquiring an NXPI. Right now, NXPI shares are trading a little over 100. Qualcomm came out with a story, there was a story out yesterday, reported by Bloomberg, saying that Qualcomm's at about 110 they'd be willing to pay, and NXPI is looking for 120. So that's actually not too far away, and it seems like those two should come to a deal sooner rather than later at probably a nice premium to the current stock level.
Yeah, and it's kind of one of those scenarios where it seems like if you're Qualcomm, you pay as close to that 120 as you have to. I mean,
right.
Obviously 110's better.
Yeah.
Buy low, sell high, people. You heard it here first. But at the same time, I mean, they need this growth. And I think NXPI is in a little bit of a power position where they're kind of in a growing subsector of that space. Right. They're in the position to actually kind of name their price, and that they're not that far off. I think there's reason to be optimistic about that actually going through. I would think this isn't something like Twitter, which we talked about yesterday, where it's just kind of all these pipe dreams in terms of, oh, everybody wants to acquire us.
Yeah.
Moving forward, another thing we talked about yesterday, Samsung, really explosive stock right now.
Yeah.
No, we talked about Samsung's phones. We talked about the explosion. We had a quote of the day that was real inspirational, I thought, yesterday from intern Scotty.
Yeah.
What's the news? What's the latest?
Well, Samsung, every quarter they come out with their results very quickly. They give this preliminary kind of guidance update, and they were very strong results, which people were a bit surprised by, because the news that they were seeing out of Samsung over the last quarter was not very good. You know, you're dealing with these recalls and dealing with people saying, you know, I'm just done with Samsung.
Your product is blowing up in my pocket on an airplane.
Literally.
Not a good thing.
Yeah. So they actually beat estimates, and the reason is that people are pointing to, and again, they don't break this out, but what analysts are saying is that the semiconductor business is just so strong that it's making up for the weakness in the mobile phone business. Which would kind of go in line with what Intel said about semiconductors, saying Intel guided up just a few weeks ago, and even Micron had a strong quarter. So semiconductor space actually may be coming up on an upcycle here. I'm not sure what point it is in that cycle though.
So Samsung, a little bit of good news for a change, which is certainly welcome. Not a lot of good news for the pound.
No.
None at all. We mentioned beyond red gasman territory.
Yeah.
It's really, really struggling. What's the macro theme there? What's the short and midterm outlook for the pound?
So it kind of astonishes me or surprises me a bit, because they have basically said we want the pound lower. We're dealing with Brexit, so we are going to destroy our currency to make it better for the exporters. So
creative destruction, right? So creative destruction of the pound.
So when people come out and say, "Oh, the pound went down," it's like, well, that's exactly what the central planners want to happen. And you know, getting a currency stronger is a little more difficult. But weakening currency, you just have to print all you want.
Yeah.
And so that's what's happening in the UK. The people said it was a fat finger error, but it seems like many times these fat finger errors tend to be a little more consequential than people might initially want to say. So consequences of a weaker pound, you know, you want to, if your local currency is cheap, you want to pay workers in that local currency and sell overseas to rich Americans, right? So if you're looking to play this, maybe one of the best plays would be to find a company that has a UK cost base and sells into even the Euro area as potential.
So any companies off the top of your head that kind of stand out as potential opportunities just because of that?
Yeah,
currency manipulation, so to speak.
There are a few. Probably one of the biggest ones is like Rolls-Royce. big in terms of manufacturing aircraft engines. Obviously, you have UTX in the United States as the corollary. GE also makes those large engines, and it's a very relatively consolidated space. New CEO there actually came in about 1.5 years ago, Warren East. He actually was the CEO of ARM Holdings when it did, when actually it performed quite well. So a little more different leadership there.
Yeah, so that's one to keep an eye on as we march forward. Merrill Lynch, couple tidbits out. The head of Merrill Lynch is out effective January 1st. John Thiel. What I thought was interesting about this story is that they're replacing him, and I don't know what the normal chain of command is there, admittedly, but they're replacing him with the head of Global Wealth and Retirement Solutions, which is interesting because you also had the headlines yesterday about Merrill Lynch announcing that they are no longer going to offer commission-based asset management for retirement accounts. So if you think about a traditional brokerage model in which you have a quote-unquote stockbroker that does a transaction for you, collects a commission off the top, that's no longer going to be allowed in retirement accounts at Merrill Lynch. Now, this was kind of positioned as a, look at us, we're looking out for you guys. The reality is the Obama administration and the fiduciary rule has kind of made that everything but law. In other words, yes, you can technically still charge commission on those types of accounts, but there's going to be so many loops that you have to jump through. From a compliance perspective, you're going to have to get more documents signed by the client saying that they understand each investment, things like that. So now they're going to go to fee-only model, which is, full disclosure, what we use at Narwhal, where, hey, people pay a set percentage of assets under management. I mean, I feel so bad for those guys having to actually look out for their clients now. Like, it's pretty brutal. That they're going to have to do that. But we've blogged about it, I think, on the Narwhal blog, narwhalcapital.com/blog. But do you have any thoughts on the fiduciary rule? I mean, my overall take is that this is a great step forward. And I think a lot of people were moving towards that on the consumer side anyway. When you look at the amount of assets that have moved to RIAs as of late, seems like, I think now RIAs control, it's either a quarter or a third of all American wealth. So a lot of stuff's moving to that fee-only model anyway.
I do think that RIAs are really disrupting a lot of the traditional ways of money management. So you also have so you're talking about broker model, which seems to be dying away, and then also you have the hedge fund model, and the RIA is kind of undercutting them on price. So there's on two sides. The RIAs seem to be taking market share, so that's my thought. And it seems like traditional powerhouses like Merrill need to adapt sooner rather than later in order to stay in front of the trend.
Yeah, absolutely. I mean, I think that's, again, I'm not going to talk too much trash. I understand the model, I understand why it worked, and I think there's plenty of people out there who do only make transactions when necessary, and those people have to get paid too. They're not working for free. But I do think it's definitely a step in the right direction, at least in terms of accountability. And I think it keeps everybody a little bit more honest, even if you're not setting out to be dishonest. Last story we've got for the market overview, Snap Inc., the parent of Snapchat, IPOing, they said as soon as March, $25 billion valuation. I think the last time they raised funds, it was like a $17 or $18 billion valuation. Ben, are you a Snapchat guy?
I use it a little bit. I have just a few enough friends that I'm able to actually find utility in it. I know that some people have like hundreds of friends on it. Like, I don't know how they're able to manage that.
Yeah, it's hot in the streets right now, as the kids would say. So Snap Inc.
Are you taking the over or the under on the 25 bill?
Over.
Yeah.
I'm taking the over. I mean, it's going through the roof in terms, and right now, Sam the Frost Man is Snapchatting us, I think, as we talk about Snapchat on the Investing Podcast. Sam, make sure they know they can download this on iTunes. I think that's all we got. In just a few minutes, Ben and I are going to do a live Periscope. All this technology, man, so much technology. Yeah. We're doing a live Periscope. Going to get some economic data in live at 8:30. Check that out. We're going to actually port that video into this video, so by the time you're watching it on YouTube or wherever you happen to consume this or the podcast, it will be imported, so pardon our lack of technology on that. We're just going to film that thing on our phone. That's all we got. We're going to turn it over to Sam Frost. He's going to talk about math. Hey everybody, welcome to Sam's Statistics. This is Sam.
This is Andrew.
We are going to be talking about numbers and what they are and how they can be used to your benefit at times if you understand them and you know how to work things like Microsoft Excel and stuff that Sam knows how to do. So today, what are we talking about?
So today we're going to talk a little bit about portfolio construction and in particular minimum variance.
Okay, so you say minimum variance. My gut reaction is we're going to see how little we can vary from something. Is that
Exactly.
Right?
So basically the goal is to construct a portfolio that just steadily trends, I guess from your point of view, just steadily trends up, has as little ups and downs as possible. Kind of makes sense because it's much harder, it's much easier to fall 10% than it is to rise 10%. So if we can minimize kind of that downside risk or whatever, then theoretically we should just steadily rise up.
Okay, so when you start thinking about that, how do you begin when you start looking at a portfolio and actually looking at the pieces in there, whether it's investments in individual stocks or funds or whatever it may be? What's step one?
So step one is going to pull historical asset prices. So you can go to YHOO Finance, so you can choose a date range, just pull the daily, monthly, weekly. Don't do it annually, but pull those prices, and then you're going to calculate the variance. And in Microsoft Excel, the formula is just var.s. But
can you write that on the board?
Yeah, we can do that. First of all, I got to say though, we got to convert the prices into returns because the prices don't mean anything. Like a 1% jump for a $100 stock is much different than a 1% jump for a $5 stock.
Right.
So the first thing is calculate returns. Log returns or regular returns will work. And then variance formula.
And so right here you would have all the cells with all the random numbers of returns.
Right, so it'd be like A1 through A1000 or whatever.
Right, so you want to have a big sample because the bigger the sample, the more accurate the data would be, presumably.
Correct.
And then I guess you would run this for each individual
For
asset.
each individual asset, right. So if you got 10, companies you're looking at, you'd run it for all 10 companies. Next step, so just to kind of break it down a little bit to you, there's a thing called the efficient frontier. So we're going to have our return up here, we're going to have our standard deviation on this axis. So you have all these companies that have
chicken pox.
Yeah. And so what this is like essentially a bunch of different companies. They all have a certain standard deviation, a certain return. Unfortunately, this is based off of historicals, which we'll talk about in a little bit. But there's this thing called the efficient frontier. That's going to be something like that. And basically what that shows is that the combination, by diversifying your portfolio, you can generate better returns on lower standard deviation. So for instance, this point out here is minimizing your variance. So that's kind of the goal, is to get to this point. A lot of people talk about Sharpe Ratio, which is essentially the best return for the risk taken. And your Sharpe Ratio is going to be this point right here, where this is the a risk-free asset. And so at this point right here, so this is going to be like your risk-free assets, like the 10-year, 30-year treasury rate or whatever. So that's like, what is it right now, like 1.7%?
It's almost nothing.
Very little. And so that's essentially saying for no risk, we can get this return, which is like 1.5% or something like that. And you have this line that is tangent to the efficient frontier. And at this point, that becomes our Sharpe Ratio, which is our best return for the risk that we're taking. However, the main issue with this is assuming that we can accurately predict returns, which so far nobody's made $1 trillion by.
Yeah, if we could do that, we wouldn't do any of this.
Exactly. If we could predict returns, we probably wouldn't even like do a podcast.
Whoa.
We would,
I don't know.
You don't think so?
I think we would. I think we would want to get out some false misinformation out there.
False misinformation.
Yeah,
it wouldn't matter
like,
because we could predict returns.
Just throw people off our scent.
We could just make like crazy calls about how things are going to react. Anyway, so the thought process behind the minimizing volatility is that we can't predict returns, but we can get an idea of variance. Variance, if this is time going that way, Variance kind of looks something like this. It always seems to kind of come back down and mean revert. And so we can actually get an idea of where variance is headed. A big thing right now in just quantitative finance is trying to figure out a way to forecast variance. And so that's kind of where we stand today.
So if we expected that this was one asset class and all of a sudden we see the returns do this, they get up there. If we're rebalancing a portfolio, most likely we're going to want to start trimming out of that asset because we expect it to come back to this mean return to there. Is that right?
Yeah. So technically what we would want is when the asset is right here, if we could find a way to forecast that volatility was about to spike, we would go ahead and trim it before it spiked.
Gotcha.
And so actually, like, once you hit this spike, the assumption is that it's going to mean revert. So maybe you don't trim out here, but you think about trimming out down here. The only issue is, like, you have events like in 2008 where volatility spiked, and then you would have thought it would have mean reverted, but it just kind of came down a little bit and then it went off even higher. And so that's where you kind of run into issues. And so the best bet, I think, is to look at this, kind of figure out what the average is, and use that as your variance number and try to minimize that for your entire portfolio.
And that's probably the example of like what you just mentioned in 08 is why it's so important to have a ton of data and to go back as far as you can so that you can account for as many things as possible. Because again, we can't predict the future, but we can analyze what we've seen before.
Sure.
Very good, very good.
Yep.
So final steps, how do you apply this? What's it look like in real time or like on a monthly or quarterly basis?
Yeah, so final steps is going to be a little tricky. You'd have to use some type of software. Excel's got some plugins that you can use. You can do it in C, MATLAB, Python, any of those other languages.
You just made all that up.
Yeah.
But I usually use Python myself.
Yeah.
Big fan of Python.
So basically the goal is this is our formula. This is our objective formula. We're going to try to minimize variance. So R transpose, that's just a vector of returns. So R1, R2, down to Rn. So that's going to be our vector. We're going to transpose it so it's this way, multiplied times our covariance matrix. So again, going back to covariance, remember we did var.s to find the variance between all of them. We got to find the covariance between all the assets, which is just going to be cov.s. And you're going to take that for every single asset class that returns, calculate your covariance matrix, plug it in here for V, then you have times R, your returns. Minimize that by choosing weights for each asset. And so again, you're going to have to do that with the software. I mean, I guess you could plug it in yourself. Make sure your weights add up to 1. You can even add short constraints.
That's a good one right there. Make sure it adds up to 1.
Yeah. You can implement. You can take it as far as you want. You know, you can short stocks or you can not. So you can make a a minimum of 0 for your weight, or you can make a minimum of, call it negative 1 or something. Yeah. But yeah, so those are the next steps. Anybody who wants to talk about it, we can talk.
So there we go. So that's what Sam does all day. Sits at his computer, and this was as much for our benefit as anything. We want to make sure he seems like he knows what he's doing because we certainly don't. But there you go. Sam's stats. Good way to find minimum variance portfolios and build them out, man. That's all there is to it. Take your notes and got anything else?
That's it. Subscribe.
And take us away, Data Dab.
Yeah, so we're here because time is running short before the jobs report, and I wanted to get you guys some hard-hitting analysis before the report, so that in 2 minutes you have all you need for the jobs day. So quickly recapping what happened over the last few days, they came out with the ISM manufacturing report. That was better than expected. It was 51.4 versus 50.4. Internally, the employment piece of that was 49.7 versus the previous month in August, which was 48.3. So that was better than expected. ISM services, the non-manufacturing side, was a lot better than expected, 57.1 versus 53. The employment was also better than expected. It was 57.2 versus the previous month, which was just 50.7. So services are hiring a lot. I don't know if it's teachers or hospital workers, but that has been the biggest driver so far. Manufacturing still under 50, but better. The analyst estimate for this new, for the upcoming non-farm payrolls report is 172,000. Last month it was 151,000, so people are expecting an uptick this month. Unemployment rate of 4.9%, and 2.6% on the household earnings. Average hourly earnings. What's interesting to note is that it takes a while for, if things do turn down, it takes a while for estimates to come down and actually get used to the new normal. But we've been in this range between 150 and 250 for a while. And Scotty, if you turn around right there, you can see what the number is.
Where am I looking?
You're looking for the big red headline.
Oh, climbs of 5%, 156,000.
156 versus 172. So a little worse than expected, which is kind of surprising to me, given the earlier data.
So Ben, one of the things we talked about in our extensive pre-production meeting is just kind of anticipation relative to reality, what leads. Yeah. Knowing what you know in terms of how people tend to expect bad news before there necessarily is some, and vice versa,
right,
and be behind. What's the reaction going to be market-wise, do you think?
I don't think the market is going to respond too badly to it. In fact, it may actually respond positively. And the reason I say that is because people, I think, are being concerned about the weakening, about the stronger dollar relative to weaker currencies elsewhere. So if all of a sudden jobs data starts to deteriorate versus what people are looking for, that is bad for the dollar because it means the Fed will be in there longer. But people like the Fed in there, so that could actually have a beneficial effect to certain asset prices. Bonds should do relatively well, but it's also important, and you bring this up, Sam, is just the margin of error on these jobs data numbers is huge. It's absolutely enormous. Like, you're talking about 100,000 is the margin of error at least, and we missed by what, 15,000? So
start panicking, everyone. Is what I'm hearing.
So right now we're doing a lot of gapping, but there probably isn't much bite to this jobs day doc.
So there we go. I'm gonna hop on. Does somebody want to hop on Market Watch real quick or something? See what futures are doing. Just interesting because we did obviously a pre-recorded session overview of the market. Dow Futures. What are they at, Krebs?
Down 7 bits.
Okay, so they've actually rallied just a little bit. I think they were down 20 or 27, something like that. So Dow Futures have actually rallied just a little bit.
Which is kind of what we were talking about.
In the last 10 minutes, which, not to brag, but we kind of called that.
Yeah.
We called that. If you watch the video, watch the tape, go back to it, rewind, re-download, resubscribe, helps our numbers here. But yeah, we kind of called that. Anybody got any other thoughts?
Subscribe.
Yeah. Check it out. Find us on Twitter for all this good stuff. We normally have a little bit more production value, I feel like, but at the same time, we got a cameraman right now. So that's all we got. Thanks, everybody. Political party. Andrew Hall back. Matt Kresbach, what up?
What up?
You ready for this debate Sunday night?
Yeah, I'm pretty jacked.
I don't know if you are, because I asked if you wanted to come on this segment. You're like, "There's a debate."
Like, as soon as you told me, I was like, "Oh, sweet!" Like I'm
right.
surprised and happy.
Okay. Oh, there we go. There we go. It's like when you wake up and you're like, "Oh, it is Christmas!" Like, surprise, it's here.
Yeah, it's okay.
Debate Sunday night. Donald Trump, Hillary Clinton.
That's who's in it.
Round 2. We're coming off this VP debate that I think everybody thought was a little bit dry, a little bit boring. I think the general consensus was that Hillary won the presidential debate. Trump's VP, Mike Pence, won the VP debate. Now, I wouldn't say at all we're on a neutral field because I don't think anybody hardly watched the VP debate, and Hillary continues to add to her lead. What's Trump got to do, man? Like it seems like we're kind of getting up to this. We're like 30 days out from election time.
It's crazy.
He's got to like pull the rabbit out of his hat, I think, at this point, right?
I'll talk about that, but I wanted to ask you a question before
Okay.
I forget
Whoa,
about it.
whoa, whoa.
To get it on the record.
On the record, let's
So like the first debate, the viewership was 87 million.
yeah.
The VP was, it was 84. The VP was 37. What are you expecting for this one? Sunday night, prime time, I'm assuming.
Do we have like an expected number or no? Or we're making up an
So
expected
let's put
number?
the line at like 80.
Under. I would
Let's
say.
put the line at 75.
I think we're gonna be around like high 60s.
Wow, that big of a drop.
Yeah.
Wow.
Yeah. I think people.
I'm not going that far.
I don't think people got what they wanted out of debate number one, which was Trump on fire. Like, I mean, I think people wanted to tune in for a disaster, and they didn't quite get it. I mean, they got one, but not in the. Like,
You don't think they'll give him like one more shot? Like, hey, he's down. He's got to
No.
pull a rabbit out of his hat. Like,
I don't think so. And a big part of my thought process on this is that like he kept getting more and more ridiculous during the primary debates, and those ratings kept going down and down and down. Like the highest rated one was the first one he did. So I kind of feel like he loses a little bit of the appeal. And I also feel like just because the gap in the polling is widened a little bit, like I feel like there's like fewer undecided or closet voters that want to turn it on. So yeah, I'm going like under 70.
I think you brought this up with the VP debate that Pence is doing what Trump should have done.
Yeah.
Just like the one-liners or
Yeah.
you know, just like little comments that you could throw in to just shut down anything Hillary could say. Like
Yeah.
about cybersecurity, you can just say, well, what about the servers?
Yeah.
Boom. Done.
Yeah, and then move on.
You won that one.
Yeah, I thought
Something
Pence-
about Benghazi in there too. I'm sure you
Yeah.
got another argument.
Pence did a
somewhere.
great job, like one-liners, and then actually like spend time on policy. And I'm interested to see. So like with Trump, there's three Trumps I feel like that we've seen. There's mad, angry, insulting Trump on one end of the spectrum. There's very scripted Trump, which we saw, I would say, like at the convention. You know, reading a speech, and then he like just had to break character immediately thereafter and go on a rant. But so you had that extreme, and then you have what I think we saw in the first debate, which I would argue is the least effective Trump,
Yeah.
which is kind of the I'm going to interrupt you, but I'm not really going to get my claws out. I don't want to get my hands dirty either, so neither claws or hands being pulled out there. So I think he was like pretty chill, but just annoying almost.
So do you think he ever had like a realistic chance at winning? Like if he stayed the course at
Yeah,
that first one?
I honestly
That
think
first Trump?
I honestly think if he had harnessed the demeanor, say, of Pence and made the whole first debate about actual issues and not spent, 3 or 4 minutes rambling about this or that or the other or interrupting with things just saying not true.
You're wrong.
No.
You're wrong.
Yeah, if he had done something other than that, that would have been effective. I also think if he'd come out guns blazing, there's a certain portion of the audience that would love for him to make every single question about Benghazi, every single question about the emails, every single question about all these things we already know
Creating
about Hillary.
ISIS or
Right.
whatever, I'm sure.
And that's what's frustrating because she's gonna go out of her way, I think, to bring up things that we all already know about Donald Trump.
Mhm.
I don't think it's going to be an effective strategy on Sunday for him to bring up. He said he's not going to bring up Bill Clinton's affairs. I don't know what he could say about Bill Clinton's affairs that would swing a single voter in the United States of America. There's never been a more high-profile cheater in the country than Bill Clinton. I mean, really.
Yeah, I know.
I mean, like, what is he possibly going to say? Like, if he knows something about Bill Clinton and his affairs with Hillary and animals, maybe we swing some voters. But short of that, I don't know what he
Maybe a
could
few.
possibly say about that guy's sexual immorality that would make people say, well, you know what, I'm not voting for his wife. If anything, I almost think it makes her sympathetic. So I hope he stays off of that. But he ought to just be, I think he ought to be attack dog going after her track record. Don't defend himself at all. Ignore that, because again, she's not going to pull out anything new on it. Don't spend 10 minutes explaining what you did on your taxes. If you can explain it in two sentences or less, which he should be able to, but he probably can't, address it and then move on.
And then talking about Hillary, I'm trying to think like what way can she lose it? Because I think that's what it comes down to. Like she kind of has to lose it at this point.
Yeah.
And I think she's just too good at like speaking, giving, debating and everything. I don't see how she loses it.
I don't know. I don't either. I think like it's.
As much like not. I'm not a big Hillary fan, but like she's really good at that.
I think she's really good at that. So I almost view it. I don't know if this is what you're saying, but my view is she won't lose it. He's got to like steal it.
Yeah.
Like, I mean, I think he's got to go way out of his way. And middle ground Trump definitely does not do that. Demeanor of Pence, for instance, I think could do that, because I think Trump's like a decent enough guy in terms of thinking on his toes and being able to like form sentences. So if he would just make the issues kind of at the forefront, I think a lot of people would say, oh wow, she looks really petty for interrupting. She looks really petty for going after this stuff that we've been hearing about for years about Donald Trump. Everyone knows that Donald Trump doesn't like Rosie O'Donnell. Why is she wasting time on this? So I think if he does that, he might win. I honestly think he's got to go like kind of all out though. It's like probably going to be his best bet to get her off her toes, because she has not come face to face with that in a debate. So if she's going to get rattled, the only way I see it is just hyper combative Trump, and even that I don't know if it rattles her.
Do you see it as a possibility of her being rattled? Period.
I think that's the best chance of her getting rattled. I don't know what those chances are, but middle ground and conservative Trump won't rattle her no matter what he does or says. He might look comparatively better, but she's not going to get off her game. The only way I could see her getting rattled at all is if he is just attack dog Trump, like to the max. And I think that's what America wants to watch.
Yeah, that would be great TV.
Yeah. Then debate 3, we probably get a spike in ratings. But what are, I don't know that there are big takeaways, but what's your expectation, I guess, for the night in terms of just Monday morning? What would you say the headline's going to be Monday morning?
Probably, I'm gonna assume that Trump's gonna try and like attack her a little bit, and Hillary's gonna handle it fine, and as soon as Hillary won the debate.
That's my gut is that the headline's going to be something along the lines of, Trump's Hail Mary falls short.
Yeah, it's a good one.
Yeah. That's
Did you have that planned out?
Had that, I just wrote that in my head.
Nice.
Yeah. So that's kind of my expectation, and I don't know what he can do at this point. I think he needs a legitimate outside source to win this election, meaning, like everyone else who's ever had pneumonia, Hillary dies. I don't know if you knew that statistic.
And she's a robot too.
Everyone who's ever had pneumonia has either died or is dying. You heard it here first, so maybe that happens. Or I mean, anything else could happen. I guess I don't want to paint too bleak of pictures of things that could happen to her. That seems a little dark for the Friday morning. But yeah, I think that's all I got.
Yeah, it's good stuff.
Political party. Y'all have a great weekend, and we'll be back Monday. We're going to do a recap of the debate, audio only, so check that bad boy out. And I think Scotty Intern's going to close us out real nice here with a quote of the day.
Remember to subscribe though. Gotta throw that
Subscribe.
Hey everybody, welcome to the quote of the day, everybody's favorite part of the show, obviously. Today I got a really impressive quote for you guys. So earlier I know we listened to Ben and Andrew talking about Snapchat, and we actually were able to find a quote in relations to Snapchat today. And I think just to preface the quote before I get into it, every generation has their king, right? You had Elvis, he was the king of rock and roll. You had Michael Jackson, he was the king of pop. And nowadays, we have DJ Khaled. He's the king of Snapchat. Everybody loves DJ Khaled. Everybody knows who he is. It's not a stretch by any means, in my opinion, to put him right up there with the best of the best. Especially when you guys hear this quote. It's going to blow your mind. So, I found an article where they talked about DJ Khaled initially getting Snapchat. It's actually a really funny story. I encourage you to look into it because he got stuck on a jet ski like out on a lake or something in the middle of the night and downloaded Snapchat because he was scared he was going to die and wanted it to be documented. So they were interviewing about this, and he came up with this quote. He said, "Everybody around me had a Snapchat, and I said I would never get on it. I'm still on Instagram, you know? They convinced me to get Snapchat. The thing is that when you see Snapchat, that's DJ Khaled. That's Khaled for real. That's Khaled. My fans are seeing me besides my records and music videos and interviews. They're seeing a more spiritual and at the same time motivational and inspirational side of me being at home." So I'm just going to leave you guys with that today. Enjoy your day. This has been the Investing Podcast.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.